According to supply managers in the 9 Mid-America states, how is the economy performing?
Our December survey of supply managers, manufacturing supply managers in the 9 Mid-America states was still not good. The December number was 48.7. That's down from November's 49.6. 50.0 is growth neutral. So this has been below growth neutral most of the year. In fact, this is the seventh time this year that's been below growth neutral, seventh time in the past 12 months. So not good. It's even when it was above growth neutral, it's still only slightly above growth neutral. So it's been, I would say it's vacillating around growth neutral. And we ask about the recession going forward for 2025. 45% of the supply managers indicated that we were in a recession or we began a recession in the first half of 2025. Another 46.3% said no recession but slow growth. Only 8%, 8.7% indicated no recession and strong growth. So only slightly less than 9% was full steam ahead. And one of the issues that we're facing in our surveys, at least according to our surveys, that is a strong dollar. The dollar's been on a tear. It's very strong. And of course, that makes our manufactured goods less competitively priced abroad. We're seeing it. We're seeing it in terms of exports. Exports are just not looking good. The export number was well below growth neutral. Of course, that tends to limit the ability of President Trump to place on tariffs. You place tariffs on top of a strong dollar, you will have some fairly significant and negative impacts on the manufacturing sector. Let me bring up the graph here. You'll see in blue there the Mid-American number in blue moving lower, of course, and as the viewer can see, it's moving around 50 for most of the year in of 2024. And I expected 2025 to be much the same. And you see there in red, the U.S. number has been below growth neutral for most of the year. And in fact, only once even getting close to being 50.0. Later on this morning, we'll hear from the national PMI, the Purchasing Management Index. But again, both are indicating very weak manufacturing sector in the U.S. But one could even say it's in a recession, but it's hardly a recession that in typical terms. It's been moving along in negative territory, and we'll talk in a moment about the job picture in manufacturing.
What were the hiring trends?
Hiring for December of 2024 was not good. It was 46.4. That's down from November's 44.4. If you look at manufacturing in the U.S., lost 73,000 jobs in 2024. That's 0.6%. If you look at our region, the Mid-America region, it lost 4,500 jobs, or about 0.4 percentage point. So both U.S. and the regional manufacturing sector not doing well. If you look at breaking it down by state, Iowa was 3%, and then we had Kansas coming at negative 0.1%, Minnesota at negative 1.8%, Oklahoma coming in at negative 0.9%. Actually, South Dakota was the most negative at negative 5.5% over the last year. Now, that's a lot of job losses. And on the positive side, we had Arkansas up by 2.5%, Missouri up by 1.4%, Nebraska, the leader there, up by 3.2%, and North Dakota up by 0.8%. So it was not a good reading unless you drill down to the states. And 1 in 5 firms reported a shortage of job applicants, even with these negative hiring numbers. 2 of 5 firms reported not hiring due to the slowdown, and the remaining 2 of 5 demand and supply are in balance. So overall, the labor market for manufacturing is not good in the region, not good in the nation. And we don't hear much reporting on that, but a lot of it you can trace back to that strong dollar and making exports weaker. And we did see exports for the nation. If you compare 2024 exports to the same period in 2023, only up by a little over 1 percentage point. And of course, that doesn't even account for inflation. So exports not good.
What inflation trends are you noticing?
Inflation, the price gauge rose to 57.1. That's only slightly. We're still in a range of indicating a moderate inflationary pressures, and that's up from November's 56.6. Now, viewers need to be aware of a lot of reporting going on about year over year. Look at the month to month. That's the most recent changes. If you look at the last 3 months of the CPI annualized, up by 2.8%. Of course, the Fed's shooting for 2 percentage points there. The core is up by 3.6%. Now the core, that's the last 3 months annualized. Now the core, it strikes out energy and food, and of course that's up even more briskly. So that'll probably come down in the months ahead because of energy prices coming down. And looking at the PPI, the wholesale price index, annualized over the last 3 months, 3.6% there. And if you look at the core, again, there, the core is better than what we call the headline number. The core is up by 2.4%, and that's annualized. Again, these numbers that I've just quoted, those are the last 3 months annualized, and all of them are well above the Fed's target. The Fed, in my judgment, is not going to be able to raise interest rates because of these higher inflationary pressures in the weeks and months ahead.
What is the economic outlook?
I expect no change in the Fed rate when they meet once again on January the 28th and 29th. And they meet after that. There's no meeting in February. There is a meeting in March 18th and 19th. At this point in time, I don't see rate cuts there. There's too much inflationary pressures, even with a slowing manufacturing economy, a slowing U.S. economy. There's too much inflationary pressures out there, but that could change between now and the 28th of January, 28th and 29th. But keep an eye on the Federal Reserve's balance sheet. That's been coming down, but that's called quantitative tightening when the Fed allows the money supply to be reduced. Now that we'll wait and see. That could be reversed, and that would be a big change. So watch that if it happens, and just go to Google and put in Federal Reserve's balance sheet, and you'll see it there. You'll see what's going on. It has been coming down. That's a tightening. In other words, at the same time they're reducing short-term rates, they're moving long-term rates up by reducing the money supply, and we've seen it in terms of the 10-year Treasury. Keep an eye on the inflation rate for in Q1 of 2025. That's released about the middle of every month. That CPI is growing. It's come down significantly, but still it's too high in my judgment for rate cuts by the Federal Reserve. Long-term rates I expect to move sideways to a slightly higher, and they'll move up and down with the 10-year Treasury. The 10-year Treasury is the most important gauge for investors and the general public to be aware of, and economists. So keep an eye on the bond market. The yield on the 10-year Treasury is now up to 4.6%. That's the highest we've seen since last May. I expect it to continue to move a bit higher, but not significantly higher. Now, if it should move above 5 percentage points, that would be a big warning signal for all of us out there. And again, keep an eye on the Fed's balance sheet. The national ISM number comes out later on this morning. That's going to be down below growth neutral, not a good signal. Keep an eye on the price of a barrel of oil. Oil has been moving lower. Now, it has moved up a bit, but still in the low $70 per barrel, and that's in U.S. dollars, and that's in the West Texas crude number, not the international number of Brent. So anyway, keep an eye on that, and we have to be really cognizant and listen carefully to what the statements of the members of the Federal Open Market Committee, particularly those that are voting. That's the 12 members. That's the FOMC, Federal Open Market Committee. Listen to those guys and gals and what they're saying. And it's almost a divide between those who are bearish and those who are bullish right now. And I'm obviously in the bearish camp. I do think the economy is cooling. I do think, unfortunately, that there's too much inflationary pressures, even with a cooling economy. Watch the price of gold also. Gold's been moving up to potentially breaking $2,700 per ounce. Now that central banks are buying a lot of that. Of course, that's something to keep an eye on. And of course, look at what's going on with Bitcoin. Bitcoin is now down to 91,000. That's down from what we saw later last year. That was in 2024 December. We saw prices break above $110,000 per Bitcoins, now moving lower, and that's could be problems out there indicating now the what's going on with Bitcoin. Now these movements, they can change, but typically Bitcoin moves up and down. I say typically the last year or so moves up and down with the stock market. Now that correlation could break at any time, but right now it's moving lower as the U.S. stock markets is moved lower. But also keep an eye on the value of the dollar. Keep an eye on what's going in international trade, because that could limit the Trump administration's. At least they've talked about raising tariffs. If you have the dollar strong, that's going to limit your ability to raise or increase tariffs. So what's that? And certainly a big thing to keep an eye out for the month of February is the longshoreman strike, which could begin on January the 15th, January the 16th, along there, because in the 17 East Coast and Gulf Coast ports, the 17 of them, we could see a strike. And of course, that would be a big, big issue. Now, President Trump has pretty good relationships with the longshoremen, but even with that, a strike at this point in time would obviously not be good news, and certainly would not be good news in our survey of manufacturers in this part of the country. So until then, again, on January the 15th, that's when the current extension of the contract ends. So until then, watch out for that number. And that's it for our survey for the month of December 2024. Join us when we once meet again on the first business day of February, which will be February the 3rd, when we report on business conditions, manufacturing conditions in the 9 Mid-America states for the month of January. Until then, may your economic cup runneth over. Ernie Goss here from Creighton University in beautiful Omaha, Nebraska.